the world's third-largest economy, is quietly unraveling. Almost nobody saw it coming. For decades, Japan existed in its own financial universe. It racked up debt that would have destroyed any other nation. Yet somehow it avoided catastrophe. That free pass just expired. Markets are waking up to a reality, economists whispered. About 4 years. Japan's debt mountain is no longer stable. When it comes down, the global financial system might come with it. Japan's government owes roughly 230% of everything the country produces yearly. To put that in perspective, the number is extreme. It makes even the most reckless spenders look responsible. Greece's debt crisis nearly tore apart the European Union in 2010. It peaked at around 180%. The United States, despite years of massive deficits, sits at about 125%. Japan has been operating in a category all its own. For the longest time, the world treated it like a miracle. Low interest rates and deflation kept everything frozen. Tokyo could borrow endlessly without consequence, but that arrangement depended on one critical assumption: that nothing would change. Everything just changed. 6 weeks ago, Japan's new prime minister rolled out a stimulus package. It's worth approximately $135 billion. On paper, it sounds like a bold move. Dig deeper, and the picture gets messy fast. The package is stuffed with handouts that read like desperation. Rice vouchers for households, subsidies for fossil fuels when the world moves toward green energy, direct cash payments that don't target productivity. They simply paper over the inflation that government policies helped create. There are some legitimate investments mixed in: funding for artificial intelligence, semiconductor production, and quantum computing. But those pieces are buried under populist giveaways. Experts are calling it wasteful at best and reckless at worst. The reaction from financial markets was immediate and brutal. Japanese government bond yields had barely moved for 30 years. They suddenly spiked. The 10-year bond yield surged to 1.9%. That's a level not seen since 1997. Back when Japan was still reeling from its asset bubble collapse, for most countries, a 1.9% yield would be low, almost boring. But Japan isn't most countries. This nation built its entire economy on one assumption: interest rates would stay near zero forever. Even a small increase carries enormous weight with massive debt. Every percentage point higher means billions in additional interest payments. Money that has to come from somewhere. Right now, there's no plan. Some economists inside Japan are drawing comparisons to something recent: the United Kingdom's Liz Truss disaster. In September 2022, Britain's new prime minister announced something shocking: a massive package of unfunded tax cuts. Bond yields exploded, the pound collapsed, pension funds nearly imploded as their holdings disintegrated overnight. Truss lasted just 49 days before being forced out. The situation in Japan has eerie similarities: a new leader pushing through enormous fiscal expansion without a clear funding mechanism, a bond market that's starting to push back, a currency that's weakening instead of strengthening. The main difference is scale. Britain's economy is a fraction of Japan's size. If Tokyo loses control, the fall. Debt service costs in Japan were already climbing before this spending spree. Now, with yields rising and borrowing accelerating, the numbers are becoming frightening. For 4 decades, Japan's annual interest payments hovered around 10 trillion yen. Even as the total debt pile grew larger and larger, that was only possible because old bonds were issued at near zero rates. They were being replaced by new bonds also issued at near zero rates. It was a cycle that seemed sustainable as long as rates stayed low. But that cycle is breaking now. As those old cheap bonds mature, they get replaced with new bonds carrying higher yields. The interest bill is set to explode. The International Monetary Fund projects that Japan's annual debt payments will double by 2030. By 2036, they're expected to quadruple. Those projections assume everything goes smoothly, that markets remain calm, that there are no sudden shocks or loss of confidence. Regime changes like this rarely stay orderly. Whispers are already circulating about extreme measures that might become necessary. Wealth taxes, targeting the assets of Japan's aging population. Forced purchases of government bonds by financial institutions. Some analysts have even mentioned the possibility of freezing bank deposits, a move that sounds almost unthinkable for a major developed economy, but it has historical precedent in Japan's post-war years. Nobody knows if things will actually get that dire, but the fact that such options are even being discussed matters. It tells you how serious the situation has become. But the real shock isn't just what's happening to Japanese bonds, it's what's happening to the yen. For 30 years, whenever global markets got shaky, the yen would surge. It was one of the most reliable patterns in finance. Investors would pull money out of risky assets. They would pile into Japanese currency, treating it as a safe haven, a store of value when everything else looked uncertain. That happened during the 2008 financial crisis. It happened during the European debt crisis. It happened during COVID. The yen would spike, sometimes dramatically, as capital flooded back into Japan. That's not happening anymore. Right now, the yen is trading around 155 to the dollar, hovering near its weakest level in decades. Despite massive government spending, despite rising inflation, despite all the factors that would normally attract foreign investment, the yen keeps sinking. It's behaving less like the currency of a stable, wealthy democracy, more like something you'd see from an emerging market facing crisis. The shift is profound. Investors aren't treating Japan as a safe haven anymore. They're treating it as a risk. There's another dynamic at play here that makes this even more dangerous. Japan isn't just the world's most indebted major economy, it's also the world's largest external creditor. Japanese households, pension funds, insurance companies, and banks own trillions in foreign assets, including an enormous pile of United States Treasury bonds. For years, whenever there was turmoil abroad, those institutions would sell foreign holdings. They would bring the money home, a flow that propped up the yen and provided liquidity during crises. Now there's growing concern that the opposite might happen. If Japan's fiscal situation deteriorates further, something dangerous could happen. If the government needs to raise cash quickly, if institutions lose confidence in domestic stability, that capital could start flowing out instead of in. Japanese investors might dump domestic bonds and move money overseas, accelerating the yen's decline and putting even more pressure on Tokyo. The implications stretch far beyond Japan's borders. The United States depends heavily on foreign buyers to absorb Treasury bonds. Japan has been the single largest foreign holder of US debt for years, consistently buying hundreds of billions worth of bonds. If Japan suddenly becomes a seller instead of a buyer, if its institutions start liquidating their Treasury holdings to deal with problems at home, that would send shockwaves through American bond markets. Yields would spike, borrowing costs for the US government would rise, Washington would face its own funding pressures at exactly the wrong time. It's a feedback loop that almost nobody is talking about publicly, but plenty of people are worrying about privately, and it gets worse, because Japan's crisis isn't happening in isolation. It's unfolding at a moment when nearly every major economy faces high debt levels. The United States is sitting at around 125% debt to GDP, a ratio that keeps climbing as deficits remain enormous year after year. Interest payments on US debt have already crossed $1 trillion annually, more than the country spends on defense. China, once the engine of global growth and investment, is facing a slow-motion disaster in its real estate sector. Local governments are buried under hidden debts that nobody can fully quantify. Europe's monetary union carries a collective debt burden near 95% of GDP, a level that's only manageable because the European Central Bank spent years buying bonds. All of these pillars of the global financial system are stretched thin. All of them are now operating in an environment where borrowing isn't cheap anymore. This matters because the entire post-2008 global economy was built differently. It assumed that interest rates would stay low indefinitely. Central banks slashed rates to zero or below after the financial crisis. They kept them there for over a decade. Governments borrowed heavily, corporations loaded up on debt. Asset prices inflated to levels that only made sense in a zero-rate world. That era is over. Global debt, when you add up governments, corporations, and households, has reached roughly $337 trillion. That number is almost meaningless because it's so large, but the trend is what matters. Debt keeps growing faster than the economies that have to support it. And now the cost of servicing that debt is rising sharply. Markets are becoming more volatile, more fragile, more sensitive to any hint of trouble. A shock in one major economy, especially an economy as large and interconnected as Japan, could trigger a cascade that spreads across the world in days. Japan's story matters because it's a preview of what's coming for other countries. You can't borrow forever. You can't assume that low rates will last indefinitely. The margin for error is gone. The world is about to find out, and the answer will define the next chapter of global economic history. Thanks so much for watching this video. I truly appreciate your time here. If you found this information valuable, hit that subscribe button. It really helps the channel grow. Drop a comment below and let me know what you think about Japan's situation. Do you believe this crisis will spread globally? I'd love to hear your thoughts on this. Don't forget to like and share this video with anyone interested in economics. Turn on notifications so you never miss an update. I'll see you in the next one. Stay informed, stay ahead.